Hello and welcome to Swissquote's Daily Market Talk. It is Thursday, September 5th, and investors are tense. They are very tense indeed before Friday's US jobs data. Now, softer than expected job openings data from the US revived the fear of further weakness in the US jobs market yesterday. So as a result of it, the US yields and the US dollar fell and equities remain under a decent selling pressure. And the Japanese yen's further appreciation gave a feeling of deja vu of last month's global meltdown. Now, the good news is there is always a chance of no disappointment when the US will reveal its latest jobs data before the weekend. So US equities remained under pressure yesterday, as I said, after the first bits of US jobs data started to come in. The JOLTS report revealed that the US job openings unexpectedly fell further in the month of July to the lowest level since 2021. The factory orders, on the other hand, jumped 5%. That was more than expected during the same month, which was a welcome addition to the JOLTS figure that could partially tame the rising recession worries for the US. But the latter couldn't prevent the US 2-year yield from falling by a big chunk to 3.75% level, a level that we last seen during the summer meltdown. Then the US 10-year yield fell to the same level as well, closing its more than 2-year persistent gap with the 2-year yield. And the US dollar index fell sharply and the dollar yen also dropped to the lowest level since the beginning of August, as in addition, the Bank of Japan's governor, Mr. Ueda, added more fuel to fire, saying that the Bank of Japan will continue to raise its borrowing costs if needed. And today's stronger than expected wage income data from Japan supported that hawkish view of Mr. Ueda. So you understood it. We are living a situation of deja vu, with rising dovish Fed expectations and rising hawkish Bank of Japan expectations, and a flight to the safety of the Japanese yen and out of the risk of equities. But this time around, the price action that we see in the market is not triggered by the actual data, but by the fear of seeing a second month of disappointment in these US jobs data that will, we understood it, undoubtedly boost the expectation of probably more than one jumbo rate cut from the Federal Reserve between September and the end of the year. Why am I saying that? I am saying that because the market is already pricing in a full percentage point cut from the Fed before this year ends. So the latter would further weigh on US yields, obviously, potentially on the US dollar as well, because if the greenback fails to attract safe haven flows, it will fall further, and probably on equities as well. And that no matter their exposure to technology. But for now, the equity traders remain quite calm. The S&P 500 retreated just 0.16% at yesterday's trading session and is sitting on its 50-day moving average. Nasdaq 100 lost a bit more than that, 0.20% yesterday, and slipped below its 100-day moving average. Nvidia fell another 1.66%, even after saying that they have not received a subpoena from the DOJ, as reported by Bloomberg the day before, but the Dow Jones Industrial Index managed to eke out a small gain yesterday, as the falling yields in the US and the rebound in the factory orders in the US as well kept some big names in the index afloat at yesterday's trading session. Now today, all eyes are on the US ADP report. So a consensus of analyst estimates on Bloomberg survey predict that the US economy may have added 144,000 new private jobs last month, a certain rebound from the 122,000 printed a month earlier. Now, a data in line with the market expectations, or ideally stronger than expected by analysts, could pour some cold water on the rising recession worries and keep major stock indices stable into Friday's official jobs figures. But a softer than expected figure will probably feel the recession worries and could further weigh on US Treasury yields, the US dollar, and the major stock indices. Also on the watch list, ISM services, weekly crude oil inventories, and Broadcom earnings today. So I have said it in yesterday's Market Talk episode. Remember that Broadcom is also expected to reveal strong second quarter results after the bell today. Now, the results are expected to be boosted by growing AI demand, a rebound in networking equipment services in the second quarter of this year, and VMware's transition from perpetual sales to subscription model, which is also thought to have contributed positively to the revenue increase in the second quarter. Now, all this is very, very good, but even good results from Broadcom are not a guarantee of a price rebound in the company's stock price, unfortunately, as investor focus has moved from corporate earnings, which remain quite robust for the technology companies, mind you, but the focus moved to the economic data, where the macroeconomic setup of the moment is not ideal for the technology companies and their stock prices. So voila, we will watch Broadcom earnings, but without too much enthusiasm. Elsewhere, oil bears didn't wait Friday's data to send the barrel of US crude below the $70 per barrel psychological level yesterday. The rising fear of US slowdown, on top of the building Chinese worries, accelerated the early week sell-off in oil. And by the way, other big banks in Wall Street joined UBS in downgrading their Chinese growth forecast to below the 5% official growth target that's announced by China. And economists at Bank of America said that they find both the fiscal and the monetary stance from China less accommodative than desired and insufficient to revive domestic growth. Mr. Xi Jinping, if you are listening to us. As a response to the recent meltdown in oil prices and the potential of a deeper dive in case of worsening economic data, OPEC Plus delegates came up and said that they are considering a possible delay to their plan to increase their production supply by 180,000 barrels from October. Surprise, surprise. But even if OPEC Plus plays it safe, their decision to extend their production cuts to the year end, for example, may not suffice to cheer up the oil bulls, increasingly worried about these waning demand prospects on the deteriorating global macroeconomic setup. And in numbers, price-wise, this means that better than expected jobs figure from the US later this week could eventually bring some of the deep buyers in and keep the barrel of US crude above the $70 per barrel level. But another disappointment from the US jobs data this week will likely accelerate the sell-off and could eventually build a resistance near the $70 per barrel psychological mark. Now, elsewhere, the US dollar's sharp fall at yesterday's trading session gave some strength to currencies around the world. In this context, the dollar CAD fell despite a 25 basis point cut from the Bank of Canada yesterday. The euro dollar traded a few pips below the 111 level, and that despite a set of softer than expected PMI figures from the Eurozone countries. Then cable rebounded from the 131 support yesterday, but there in the UK, the stronger than expected PMI figures actually reinforced the improved growth prospects for the UK economy. So the outlook for the euro sterling remains bearish at this point in time, not only because the British economy has been performing better than its European peers, but also because the dark clouds over the United Kingdom are finally dissipating, because earlier this week a bond sale in the UK attracted record demand thanks to higher yield on gilts, a sign of restoring confidence for the UK politics after the Conservatives were ousted from the leadership of the country. And on top of it all, the Bank of England also displays a more moderate stance, a more moderate dovish stance than its Western peers, which is also a reason why investors and pound traders see a brighter future for sterling against both the US dollar and the single currency. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.